Stocks got some really good news last night in terms of COVID vaccine from Moderna that really juiced us up at the beginning of the day today. And what was even better is while we filled in a lot of that gap from the morning, we were able to redo the move with a lot more volume than the overnight trading later in the afternoon. So really good bullishness that can lead us to a lot more bullishness here going forward. The question is, when are we going to get this intermediate pullback? Is it going to be sooner? Is it going to be later? What are the ramifications of each? What will happen if we get it sooner? What will happen if it's another month or two later? Because there will be one. We never have gone without one, so there will be one. When will it happen? And what are the ramifications of that? So I'm going to break that down to see what we want to see and how that's going to affect and what will happen in either case, how we can manage and trade either way. And then we're going to take a look at a stock that's in that healthcare sector that's giving us a really juicy trade patterns on its chart. So let's go ahead and get started. Today is Wednesday, July 15th, 2020. This is the market outlook from MarketScholars.com. My name is David Settle. All right, well, let's start off taking a look at the S&P 500 with the market forecast indicator. You can see the nice little jump. Didn't quite clear the high from what would that be, from Monday, or this close on June 8th. But we got up there, and so we've made the trip from the 23% line back up to the 0% line. We almost got an overbought cluster. All four lines, are above 75, with market sentiment being the lowest one, but it's above the 75th percentile. So very decent move there. You can see there's a transition that markets usually make when the short-term sentiment usually peaks up above the market sentiment line, and then it starts peaking kind of below it, especially the momentum line. And that's kind of when you start slowing down. Well, here's all these peaks up above here, and still that we're up above. There's going to come a point where we start peaking down below it, right? And you can see how that was the case here as you peaked down below the market sentiment line before you started to get back above it again. So same thing with the intermediate line, of course. It's nicely above its market sentiment and rising. I mean, it's bullish all across the board. Bullish intermediate posture, strong dark green shading, green line. Market sentiment line's rising. We're above the intermediate line's above it. Short-term sentiment's bouncing back up above 50. We talked today in our class about this little move down here got us to that 23% retracement of the new near-term rally we've got coming off of this low point yesterday. So that's our nice, but this is our nice new run that we've got going on here that we're going to kind of keep an eye on. Very good opportunity for us to, move the 0% line up. Remember, we still haven't got the 38% retracement. That's when the intermediate line pulls below 50. We get a new, that's what a pullback is. Anything in between this noise. I heard today on TV someone talking about how we've been basically in a sideways trend for the past month and a half. And I thought, no, we haven't. We've been pretty bullish here. Look at the intermediate line's green line's been rising this whole time. We've been dark green shading for most of this time. But the reality is, once we cross above this area here back on May 26th, so almost 2 months, just a week or two less than 2 months, we've been stuck between this 23% line and the 0% line, and we have gone sideways. So we have been in this kind of sideways trend. We've got a lot of a lot of light pink shading, not dark pink, but we got a light pink shading. We got a yellow line, so that pattern ended up turning out to be a bullish signal, and now we're kind of flirting with the top end. So yeah, we've been sideways, both a little bit of a bullish slant because we're at the top end of that sideways action. The Dow Jones Industrial Average is also working its way back up towards its 0% after flirting with breaking below the 23% line. We got back to dark green shading and green line again with yesterday's big jump, and then today's confirming that. And you can see now we're back up to that 78% line. We failed there before. We got up, came right back down, and failed there. So now the question is, are we going to do what the S&P has done? Are we going to do what the NASDAQ has done and clear that 78% level? NASDAQ did it way back here. Clear that 78% level and change the trend, right? The Russell 2000 still kind of lagging, but very good bullish close. Look how bullish that close was, closing above all these highs. We don't have dark green shading yet, but we're back to a green line. These short-term sentiments getting back up above market sentiment. The green line's turning back up, even if it's not above 50 yet. So that kind of tells us how much room we have to go up here in the short term. It might not go up to the same extent as we've seen, as we got some rate of change indicators that are starting to head lower. You can see the rate of change over the last 3 months in the S&P has been gradually getting smaller. So it will start slowing down. We won't get this kind of rally, but the reality is it's a pretty decent move on the markets, and we're in a bullish trend right now, and the RSI is crossed back above 60. We'll see if it holds. We're staying above the 100 mark on the CCI. When you look at other oscillators that we tend to look at here, like the DMI indicator, give it a second to load up here. Okay, here we go. So you can see we're back above 25. We're flirting with getting below 20. Remember, it's getting above 30 is when we're back to kind of being bullish here. You also notice the ADX, like we're not close to clearing the end of this trend. I mean, that's another sign about how quote unquote overbought we are. All right, if I were to go back here about 5 years or so, coming off of this low point, you can see we had very strong ADX, right? And the ADX usually peaks early on the downward moves and then starts to fall back down. You can see we eventually did get the ADX to get above 30. I actually got to 35 with some dark green shading here by the time we got the intermediate pullback, right? So that makes sense, right? You can see you get the really high ADX levels at the end of the bullish runs, and then the high ADX levels at the beginning of the bearish runs. We don't have a high ADX level in either direction right now. So we are not even close to being, quote unquote, too overbought right now on stocks. So that kind of goes to show, again, number one, how sideways we have been since this May level, because the ADX was rising and it did get above 20. We got light pink shading there. So it was looking pretty strong, like we were going to head towards, but then we just went flat. And that flat is kind of turning into our intermediate pullback, even though we never got one officially. So that kind of is something to keep an eye on. If you look at the QQQs, it's a little bit of a different story, right? Its ADX is not down to 10. Its ADX is above 25. Again, getting above 30, getting up to this 40 area, that's when you tend to get these high levels. So even the Qs aren't extreme on the overbought condition. And then finally, when you look at like the Ichimoku cloud for the S&P, you can see we're starting a new bullish trend. But let's look at the weekly trend for this. And you can see the weekly chart had been pretty strongly bullish, and you can see the bearish move. And you notice, even though we're back above the weekly cloud, we haven't restarted a new bullish trend yet. Just like over here, we finally kind of got established above 2.5 and above. We didn't quite get to strongly bullish before the first intermediate pullback, but we had gotten above the cloud. We had gotten to up above 65 and above 2.5 before things rolled over. We did get the breather. You notice we're just barely getting above 65 and we're above 2. So we're not quite there yet, even if on the Qs it's a different story again. If I were to go back to the Qs, this is the weekly chart. It is strongly bullish on the weekly chart. So it's really kind of taking a run. On the other hand, the Russell 2000 is actually still in the bearish trend. It's still well below the cloud. It's still below the bearish trend. So again, it kind of gives you an idea of we are hardly extreme in our overbought condition. Yes, valuations are high. Yes, there's some other signs that are pretty overbought themselves. But from a broad market standpoint, the Qs are extremely overbought. That's just the nature of the beast. You look at the linear regression here, no matter what time frame. There's the 1-year chart, but especially if you go back to like the 10-year chart, the Qs are extreme and they're overbought. I mean, they are very, very, they're 2 standard deviations away. That's overbought. IWM, on the other hand, not even close. So again, until we kind of get more bullish, it doesn't have to get extreme on this, but until we get more bullish, we can expect the markets to stay on this trend for, like 98 and 99, where the Qs just kind of went nuts as the market pulled forward a lot of that tech spending in a very similar situation to what we're seeing right now. Alright, before we look at some other charts, I invite you to subscribe to our YouTube channel. Mouse over this icon right here. Click the red subscribe button that pops out. There's also one down below the video if you're watching us there on YouTube. That notifies you when our videos are posted. Hit the thumbs up icon down there too. That tells us two things. Number one, you liked our video today. And number two, you want us to do another one tomorrow. If you like our videos, you want us to do them again, hit that thumbs up. You can do that right now while you're watching. If you don't like our videos, of course, you don't have to click on anything. Also, too, while you're down there, comment. What questions or comments do you have about anything I talked about in the video today? Love to hear your thoughts and what you're thinking or what you have questions about. You just post those in the comment section. Join our website at marketscholars.com. There's a link popping out right there in the top right corner of your screen. Click on that link to subscribe to our site for free. Follow us on Twitter for more content between the videos from day to day. And join our Market Outlook Facebook group that we've created. If you're watching us on our webpage here, check out some of these other links that are around. For example, click on this. That will take you to your Market Outlook Live. Every day I do the Market Outlook. I also do a live Market Outlook session at 3:30 Eastern Time the same day. We look at all of our old trade ideas. We continue to manage them. We also put on today's trade idea before the market closes, which is good for today's idea because we have earnings coming up tomorrow morning. So that's a benefit, and again, all of our subscribers, our monthly subscribers and our premium subscribers get access to this. Also, all of our monthly subscribers too get access to all of our classes. So all of our classes are listed here. The next three are listed there, and view more. The only two that are for premium subscribers only are the Q&A sessions, where we just open it up to you and you dictate, you ask us what you want us to talk about, and that's how we fill that class there. Also, click this heart. That opens up this new window. When this pops up here, click on that like button. Also, click on this thumbs up. It opens up your Facebook page. Same thing, click on this like button right here. Again, that benefits us because the more that you click on these, the more Facebook and Twitter will promote our content to all of our followers because of the engagement that they have. It also benefits you because Facebook and Twitter will promote content in your timelines from the accounts that you engage with the most. So we try to make it really easy for you to engage with us here. Alright, coming back to the charts, as you can see here on the long-term chart, whoops, not that one, we'll get to that one in just a second. But on the long-term charts, you can see the S&P 500, look at that nice, good bullish candle. In fact, we are right now closing above last week's high. Again, that's significant on the Heikin-Ashi close because that's more than just the regular weekly close. That is an average price of the week's open, high, low, and close of the regular candle. This candle here. So it takes the average of these four prices, the open, high, low, and close, even though that's a little bit of a hanging man pattern there. It takes an average of those four prices and comes up with this close. And to be above these last 4 weeks highs is very, very bullish. Obviously a higher high, higher close, no lower shadow, very bullish pattern. Rising momentum, still got, as I've shared with you before, and if I were to now edit this, and I shared with you this last week, but if you see, we've been above the current level. We've spent the last so many years in this, like for example, this bullish run that we had coming off of 2016, that entire bullish rally, you can see how long we have PPOs higher than where we're at right now. In fact, it's kind of when we get to these levels that it really kind of takes off in both of these charts. So very, very strong PPO and a good chart pattern from that perspective. Let's take a look at the three green arrows. Obviously, three green arrows there on the S&P 500. If you look at the two-line versions of this chart, you can see we're easily got above the rising 8-day moving average. The MACD is rising. The stochastics in the reversal zone, which means buyers are in control. Really, it's kind of hard to be too much more bullish than this, especially with the S&P pushing up again against the upper band. Bandwidth is rising. Remember the ADX being as low as it is. Bandwidth is rising. We've got this little volume node here that we need to clear, basically the June 8th high point. If we clear this high point and get above this 325 level, which is the top of the value area, it's clear sailing. I mean, that's all we have higher is the pre-COVID February divergent move that we had. This time you can see we've got a good move to get up to that level. So very, very strong bullish pattern across a lot of these indicators for the S&P. Let's take a look at the intraday chart for the S&P 500 and see the new 4-week high we got early this morning. We even filled in the gap today. So we gapped up on the Moderna news, but then we filled in the gap pretty easily, and then we finished the high of the day. So man, so you can see the move to this level in the overnight and the morning session, not nearly as solid. That's why gaps get filled, right? So not nearly as solid as the move from the middle of the day onward. Much more solid, much easier to hold that kind of breakout. You can see we're above, on the 4-week chart, we're above the value area easily, well above the point of control. So again, another kind of pretty strong bullish pattern here. If you take a look at the volume, the trading range, about half the average. Now keep in mind, we closed at 318.92. The low was at 319.27. So you had about a half a point of gap that we didn't actually fill in from the close up to the low. So you add that in. So we're still below the average, even if we're at about 4 points. And then the volume starting to taper off again at about 87 million. So when you put those numbers in the context, we're still, got a relatively high ATR. It hasn't started to drop yet. It still hasn't started to drop below. Sorry, here, I think I changed these. Give me one, so there we go. So we're still, flirting with the 2% mark. Remember, we don't establish a slow grind trend until we break the 1% mark. So that just means that, again, we could get a 38% retracement here, which would be like close to 15% move to the downside because of how big this rally has been. So keep that in mind that, we're just because we're bullish doesn't mean we won't be volatile, even on the drops. The drops, you can see the 23% line has been pretty significant, causing some heartburn during these little drops. Imagine now a 38% decline. It's really going to cause some heartburn, and it's going to be great for us because we know that there's a good chance we can move off of that with some really good returns, especially with the VIX as high as it is. If you see, where the VIX is right now, it's not dropping. We're still in the high 20s. So if and when we ever get a 38% retracement, and we are a little oversold right now in volatility, but if and when we ever do, there's a good chance that we move up towards, these old high points here, 40 to 45. There's a good chance that that's where we peak, again, on an actual 38% retracement move, which means the bounce off of that low point is going to be a nice, good, solid move because moves off of these lows, off these high VIXs, can create some good intermediate runs. Now, we didn't start a new intermediate run there, so we didn't have as strong of a move off of this peak. But when we start a new intermediate run, we can expect good multi-month, good strong returns. So that's why we say when everybody else is going to be, crying in their bathwater about how bad this 38% retracement is, we'll be sitting here thinking, okay, let's get it going here. Let's get some of these strong momentum stocks that have pulled back, off of their strong gains right now, down to some better support levels. And then now let's be able to get back into them and see how long they'll take us to the upside. Again, a la 98, 99. Very similar type of situation. So to summarize our technical outlook before we look at some other charts, strong bullish postures. We have the possibility of a good near-term run here. Again, don't expect a good 3-month rally to start from here. In fact, we are now over 3 months into the current intermediate rally. It would be ideal if this next near-term run might be our last one. That would be the ideal because as we've seen in the past, when we get to the 4-month or especially the 5-month intermediate rallies, the 38% retracements are bloodbaths. And they're very uncomfortable, and we're talking like 15 to 20% moves if we were to continue up with a few more near-term runs. So again, it won't be the end of the world. In fact, it'd be great for us, but people would be going nuts. So that's kind of what we're looking at. Until then, strong trends now that can lead us to another, at least this current near-term rally and push us up towards those February high points. I think there's a good chance we can push up and hit those February high points before we hit a 38% retracement. So what do you think? Do you agree with that technical outlook? Do you disagree? Comment down below, especially if you disagree. Comment down below with what you're looking at that suggests why you might be either a lot more bullish than I am, expecting more multiple months, not just a one near-term run, but maybe a new intermediate run to come out of this. Or what are you looking at that suggests that you're a lot more bearish, that this is all kind of a lights and mirrors, right? And we're going to be going down a lot more than just 38%. So if there's something that stands out to you as to why you believe that, share with the community down below. All right, now let's take a look at what's driving this price action. And you can see, again, where the winners are. But look at that big, strong run up there by IWM. So it took a charge today. Everything else was up, but it really took a charge. And let's take a look at what that looks like just on a one-day basis here. So we'll look at just today's move. And you can see, I mean, we started strong and we ended strong, up over 3.5%. Developed markets outpaced emergings. They had up just a little bit of a run. And you can see long-term bonds were down. The dollar was down. The Qs were kind of flirting with zero the whole day, as well as gold was kind of flirting with zero the whole day. High-yield bonds had a nice, good rally as well, and that's been a rare sight for them. And investment-grade bonds, well, there's commodities up at the top. Investment-grade bonds also had a relatively decent day. So with that in mind, let's take a look at some charts here, and let's look at the dollar first. I've shown you this chart before, and you can see how we continue to move lower. We continue to fall down, and so if you look at what's driving that, a lot of it's this euro. Look at that nice, good breakout on the euro. Moving up higher, strong bullish posture. Above the intermediate line, still rising, making a good run from an Ichimoku cloud perspective. You take a look at this here, and you can see we're above the cloud, we're above the green line. The green line crossed back above the blue line. Strong daily trend. And now when you look at a weekly chart and see what the long-term perspective is looking like, you can see we're just getting started on any dollar weakness here. The euro hasn't had a strong trend until way back over here when it crossed in May of 17 above that cloud. And we were pretty bearish there. We got above the green line, and so we were kind of flirting with that here, but now we're through the cloud. We really broke out, a little bit of a retest, broke above. You can see the red lines crossed above the price for the last so many weeks. We had the beginnings of a bullish trend. We've a little bit of volatility here, especially with this chart kind of throwing off things, but we're not anywhere close yet to a strong bullish trend. In fact, from a 38% retracement, which is this blue line, let me get rid of this blue line here, 38% retracement level. Here, let me do it this way, since I've got a new, so you can see it a little bit better this way here. You can see here, as of this week, now the week's not over, but as of this week, we are crossing up above the 38% retracement level on the euros. Let me close up this one here so you can see it a little bit better. See how we're closing above. That's significant, right? That's a little bit of a cup and handle, cup and a handle there. Obviously, you would expect, the difference between these two levels, so 114-ish down to about 106, so about 800 points. So we're looking about 124. So that's a move back all the way up. Is that right? 700 pips? No, 121, sorry, about 121. That's a move back up to this 78% retracement. That's a long ways down for the dollar, which is very, very good for risk appetite as a whole. The dollar, when it makes big moves like this, stocks really do well, as they did in 2017. So, very good sign for the market as a whole. Let's take a look at TLT. So again, this is the long-term bonds, and again, safe haven trade. So what's another factor besides a weak dollar that can drive stocks continued kind of a long-term move to the upside? Well, the unwinding of this strong bullish trend on the safety trade, right? Now, gold doesn't necessarily have to unwind. It might slow down, but the weak dollar is going to keep pushing this up. So this doesn't have to unwind. But long-term bonds more likely will start to fall down, break back down below this 23%, break below the 38% retracement. There is a good opportunity. Even if you were to say, you know what, let's activate this and let's just go to like this high point. That seems to be more of a more of an established high because it's not so crazy. One kind of a crazy move there. Even if we were to use that, we still haven't broken the 23% retracement and held, and much less drop below the 38 where there's going to be some support, or even beyond. It can fall below all the way to the 62 as of right now and still be in the cloud, much less a little bit later start falling. The red line's not even close to dropping below price yet. So there's a lot of unwinding of the safety trade, at least in terms of long-term bonds, to occur. If you look at the 10-year yield, the 10-year yield is actually still bearish here, still below this falling 50-day moving average. Again, not anywhere close yet. And again, it's hard to be too bearish from a recessionary standpoint with yields as low as they are. So very, very good long-term perspective. Even if we might get a intermediate pullback here pretty soon, doesn't necessarily mean that we might not have still another year or year plus left some potential really strong returns as the VIX works its way, from wherever it peaks after the next intermediate pullback, whether it's 40, 45, all the way back down, potentially back down to 15. And these yields work their way all the way back up to, wherever it's next, wherever it will peak before this, long-term run and risk appetite finally wanes and tapers off. All right, now let's take a look at the sectors and how they performed. And you saw today it was an interesting performance because it was the trash. Like, you have all these cyclical areas. You can see energy. Energy's made a nice good run the last week or so. But just looking at today alone again to see what this performance has been, you can see energy, financials, industrials, materials. So all your trash did very well. Discretionary held up with healthcare, obviously with the good news from a healthcare's perspective. And then down at the bottom, you have utilities and staples lagging, which makes sense on a risk-off type of move. Utilities and real estate lagging, and you can see technology and communication services also lagging today. But again, like we talked about before, it's one thing for them to lag on down days. It's another thing for them to lag on up days, which is okay for temporary underperformance on the up days. You can see energy really bottomed out here on 7.9. If I were to go back out to 7.9 to see, how things have done since then, let's leave it at that. You can see the nice good run in all of this trash. So again, that's IWM outperforms in that environment. These cyclical areas, they have a long ways to come. You see they're way down here on the 1-year basis. So don't be surprised if we don't start slowing down in some of these areas, but still maintain really good bullish trends. And these that start to overtake them because they've got more room to run up, to catch up. That doesn't mean that they have to fall. It just means that you might get better returns out of some of these trashier areas for the next little bit, whatever the intermediate term is. Let's see here. It should fluctuate as that QQQ to IWM relative strength chart kind of goes up and down. There is your QQQ type names up here at the top. You see how they're doing. You see energy and real estate and utilities. Look, dark red line or red lines, dark pink shading here, light green shading, but we're easily below 50 on that. You can see energy's been the biggest loser, dark pink shading, red line, but materials is nice and strong and bullish, as well as industrial. See, it's dark back to light green shading, intermediate line you're starting to move up again. Financial. Dark green shading, they've got a lot of room to go up. See, these 85, 83, 86, 23, 30, they've got a lot of room to head higher. Healthcare kind of breaking out in the 3-month basis. Staples doing pretty well too, kind of, catching up a little bit with this discretionary, with this consumer driven. So really the biggest kind of losers right now that you would expect would be utilities and real estate. And you would expect, and again, they had a good run. Like if you go back to this chart here on a sector comparison there, you go back, let's say go back a couple of years, you can see they had a good run. There's utilities, there's staples, going back from, pretty much all the way, if I were to go to January the 26th of 2018 when the stealth bear market started. they've had, I mean, they were up 30 to 40%. Even with technology higher, they were up 30 to 40%. They're just now starting to pull back below the broad market as a whole. 13%, 9% for real estate. They're just now starting to lag. So they've got a lot of this that they've got to unwind. They're not they're not overbought sold in the least bit. They were strongly overbought there. And if we were to go all the way to 219 now to see, okay, well, how have they done since then? 219 of 20 all the way up till now, you can see, there's their underperformance. They held up okay. They pulled back during the declines. Now they're still down 18% off of the February peak, while all these cyclical areas are actually positive now for that. The S&P is still down 4% from that level, but these cyclical areas are up. You still have some 20% drop in financials, 15% drop in industrials. So they still got a lot of room to make up here if we're going to maintain this bullishness over the next month or so. All right, so with healthcare making a run, that's where I wanted to do our trade idea of the day today. If you take a look at one of the stocks in that area, Abbott Laboratories, look at that nice, beautiful cluster, overbought cluster. It's one thing to get an overbought cluster when you've been bullish for multiple months. It's another thing to get an overbought cluster when you're just starting an intermediate run. It means you got a good chance, especially when you've kind of had a dip. We might get a little bit of a cup and handle before we really take off. Kind of like in one of our classes, we traded Tractor Supply back here on that cluster when it was at the beginning of an intermediate run, and you can see it kind of had this big drop too, and it had a little bit of a pullback immediately after, but you see the nice good rally. It's made sense on that cluster. So again, one thing to get clusters when you have a mature run. It's another thing to get one at the beginning of one. So very, very nice move. We like that. Now, is Abbott Labs going to make similar move? Who knows? You do have earnings coming up tomorrow, but it is a nice, good-looking pattern, especially when you look at some of these other charts, like the RSI and the CCI. Very bullish patterns there. You look at the DMI and the ADX, and you see very, pretty bullish patterns there. Not quite above 30 yet. The ADX is really low. It's got a long ways to go before we get dark green shading, which is above 25 on the ADX. So a long ways to go there. You look at its Bollinger Bands, and you see that we are pushing up. We're breaking out of the upper Bollinger Band. In fact, we're also breaking above the, right here. We're also breaking above the Keltner channel. So with the bands kind of in squeeze mode. So very, very good pattern there. If you look back at the Bollinger Bands, you see we're also breaking above the value area. So nice, good breakout pattern. From an Ichimoku cloud, you see we got back above the cloud. We're getting a moderately strong trend above 65, above 2. That's the highest level it's been at during this whole noisy period. Same thing with the trend quality indicator. From a long-term perspective, you can see a nice, good bullish Hakinyashi candle coming off of this pullback with the opportunity to make a little bit of a leg higher here, like we've seen in some of these others. So there's a lot of opportunity in Abbott. So in our Market Outlook Live, I broke down the differences between doing a call option and doing a vertical spread. So I'll kind of leave that discussion for that Market Outlook Live. You can break that down. But as you can see, what we did was we did the vertical spread. We sold the 110, which is outside of the 1 standard deviation move, because the idea is we are in the value area and we do have earnings coming up. So we do have an opportunity to make a pretty decent move coming out of this. And if we don't, we've got a very small risk, much smaller than normal. Well, not much smaller, but smaller than our normal risk. Again, usually we go half anyways on directional moves. We went even smaller than that. So if it doesn't work out and earnings go in the wrong direction, fine. We'll take a few $100s loss. But if it does work out for that few $100s, we have the potential reward of about 2,500. And if we only get to the 107 area, which is 1 standard deviation, you can see we have a potential for about $1,000 for a couple $100 of loss versus the about $500 if we had bought the call option. So very good opportunity here and if we do get up to this 107 or higher, Then we can say, okay, well, I would like to buy. We'd have established this bullish breakout. Then I can buy a call option. I can kind of roll this into a long call for November instead of doing the November call now for the same risk essentially. I get a better reward for August expiration, and then I can buy the November then, and it would actually be just a little bit more expensive, but not very much. I'd have a lot of gains to pay for it anyways. I might end up buying the 110 if we get all the way up here, kind of the at the money, and then I can just let it trend trade after that. So a little bit of a kind of a juiced up return for the first expiration cycle, and then of course the option to keep it going afterwards if I want to, instead of starting with the call option now and seeing what would happen later. Alright, so that does it for today. You've heard from me now. Now I want to hear from you. Use that link popping out in the top right corner of your screen, and it takes you to our Market Outlook forums. Open up any new thread with any questions or comments you have, and let's keep this discussion going. What do you want to talk about from what we covered in the video tonight, or for that matter, what we didn't cover that you want to talk about? And if you see somebody else opening up a thread, be sure to reply to their thread. And let's, like I said, keep this conversation going here. Again, thank you very much for watching. Remember to subscribe to our YouTube channel, hit the thumbs up icon, comment on our video down below, follow me on Twitter for more content between videos from day to day, and join our Market Outlook Facebook group that we've created, as well as our website at marketscholars.com. Have a great rest of your Wednesday night, everybody, and we'll see you all next time.